Hey guys, hi, good morning. Hello, hello. Can you please confirm if the audio video is all right? Okay. Morning, Utkarsh, Athar. All right, good. Time to wake up, get started. Time to start learning. Today is an interesting session. We have about 60 minutes at hands today. We're starting a new topic from CFA level 1 FRM. And what we would be learning is a very interesting reading called income taxes. All right, so I'm going to get started right away. Just allow me a minute to share my screen. Okay. Income taxes, right? Now, on the face of it, this reading looks a little difficult. In fact, one of the reasons why I thought I wanted to go live on YouTube is just to kind of help all of us get basic understanding of how this reading works. When you see this reading, right, and you try to read technical definition, it sounds really intimidating because it talks about stuff like deferred tax assets or deferred tax liabilities. So what I'm going to do today in this session, I'm going to try and dumb this topic down to a level where it becomes extremely intuitive. Right. So I'm going to get started right away. Here's my first question to you. Let us say that we are looking at some sort of a expense. All right. Let's say rent. So your rent expense during the year is, let's say, 500. Right. So you were supposed to pay 500, but for some reason, the amount that you actually paid, let's say, turns out to be 400. So you were supposed to pay 500, but you paid 400. How are you going to treat that remaining 100? You were supposed to pay 500, but you actually paid 400. How do you think we should treat that difference of 100? Do you think it's going to be a liability? Do you think it's going to be an asset? How do you think we should treat that? Come on, I expect each one of you to participate. The difference of 100 will be what? Asset or liability? It will be a liability, right? So we'll say we'll create a liability and we'll give it some name. We'll call it as outstanding rent payable, and that difference will be 100. Right? So that's a simple concept. It's an intuitive concept. We understand this. Let's see, I was supposed to pay 500. For some reason I paid only 400. Okay, fair enough, no problem. We're going to create a liability of 100. Right? Easy, simple, straightforward. Now, second scenario. Again, let's take some expense. Rent expense. Let us say you were supposed to pay 500, but for some reason, and a different scenario, right? Independent scenario, nothing to do with one. For some reason, you decided that you will pay rent paid. Scenario 2 is independent of scenario A or scenario 1. Rent paid is, let us say, 650. Now tell me, how do you treat that difference of 150? Is that going to be an asset? Is that going to be a liability? What do you think? What do you think about that difference of 150? What happens to it? Is it an asset? Is it a liability? So here you would say, you know what, we've paid more, right? We've paid a larger amount than what we were supposed to pay. So the difference, I'm going to treat it as an asset, right? And we're going to call it as prepaid rent, rent paid in advance, and then we're going to create an asset worth 150. इतना तो समझता ही है ना, right? This is an easy concept, right? If I paid less, it becomes a liability. If I paid more, it becomes a rent. Now, this reading on the face of it will look really fancy. Okay, so when you start reading the technicalities of the reading, it will feel like, oh my God, what is this? But if you understand this, more or less you understand what CFA Institute expects from you in this particular reading. Simple, straightforward. Now just think of it, instead of rent, think of it as tax expense. Okay, it will be called as income tax expense, but let us say tax expense of 500. And for some reason, taxes paid similar, right? Same as rent. For some reason, taxes paid is 400. So I was supposed to pay taxes of 500, but I paid only 400. That means that difference, which I haven't paid, should be a liability. And that liability is given a fancy name. Okay, that liability would now be called as a deferred tax liability. Deferred tax liability. Here we'll create a deferred tax liability of 100. Now, going forward, I'll just be calling it as DTL. It's kind of a tongue twister. So DTL, deferred tax liability 100. That easy. Right? I was supposed to pay 500. For some reason, I paid 400. We'll explore why. Right? But for some reason, I paid 400. It becomes a deferred tax liability. In the same way, independent scenario. My tax expenditure during the year was 500. Again, for some technical reasons, if tax paid turned out to be 650. Okay, now I'm using the word paid. Ideally, the word I should be using is payable, but we'll get into technicalities a little later. So tax paid turned out to be 650. What do you think we do now? Now we create an asset. Can you guess the name of the asset? What do you think we should call this asset as? I was supposed to pay 500. I paid 650. So we have to create an asset. Guess the name. Yes, deferred tax asset. Deferred tax asset of 150. So we'll just be calling this as DTA. Right, that's your basic premise. That's your concept number one. This is kind of a building block. Now, if you've understood this, then you can give me a nice, large, loud I pass on the box, or we pass, and then we move on to concept number two. Now, if you've understood this. Okay, that's great. Good to know. Fantastic. Good. Now, second building block of this reading, second large concept. Now, this gets very interesting. And obviously, in order to simplify the reading, I'm going to exaggerate things a little bit here, but that will help you kind of get an intuitive understanding of accounting. By the way, those of you who've come in late, you haven't missed anything. What we've discussed so far. If my expense of tax is 500, if I pay less, I create a deferred tax liability. If I pay more, I create a deferred tax asset. That's the only thing we've learned so far. Here's your concept number two. Every organization, and again, it's coming at the cost of some exaggeration, but it's probably required to kind of understand this reading. Every organization prepares two separate books of account. Every organization prepares two separate books of accounts. Sounds like some sort of a eureka moment. What do you mean by two separate books of account? So every organization will prepare a book, and again, for simplicity, I'm going to draw them like a box, and we are going to visualize them. So we're going to say an organization prepares a book. One is called the accounts book, and the second book, we'll call it as the tax book. So both of them are some sort of a books of account, but one of them we're going to call it as accounts book. One of them we're going to call it as tax book. Okay. What's with the accounts book and tax book? Why does an organization require to prepare two separate books? So because the accounting rules, and can you give me a couple of examples of what are these accounting rules? The rules of account that we use, the rules that we use for preparation of books, what are they called? Accounting rules, IFRS or US GAAP, right? IFRS or US GAAP. So accounting rules can be different. Accounting rules can be different from taxation laws. So accounting rules are different and taxation laws are different. Okay. Then the question you want to ask yourself is why? Why create so much of complication? Why are the accounting rules different? Why is the taxation law different? So the answer lies that the rules are different because the objective of accounting rules, which is accounting standards, and tax laws is different. Okay. So the objective of the two rules is different. So then the question comes, okay, if the objective of accounting rules and tax rules is different, so what is the objective, right? Why is it different? So in general, the objective of accounting standards or accounting rules is that an organization should present, some sort of a true and fair view of books of accounts. True and fair view of books of account, true or fair view of the business, which means धंधे में जो हो रहा है वो सही सही दिखाओ, right? Whatever is happening in your business, give us a clear picture of what's happening in the business. Give us a fair picture. Give us a relevant picture of what's happening in your business. Those are your accounting rules. ये objective है. This is the objective, true and fair view. But how about tax rules? What's the objective? Tax rules have a variety of different objectives, right? At times the objective of the tax rules is to collect higher tax revenue, and collect it faster. Collect the same tax revenue faster, as early as I can, as much as I can. So at times taxation laws, they want you to pay more, right? So that could be one objective. At times there are some social objectives, right? For example, let us say that you feel that certain part of the country needs to be promoted, the economic development needs to be better. So you want to incentivize businesses to set up manufacturing plant there. And if they do that, you give them some sort of a tax break or tax benefit. Right? So in India, for example, northeastern states, they get these type of benefits. If you go and set up in certain northeastern states of the country, you get tax benefit. So tax rules have variety of different objectives, whereas accounting rules objective is that you show true and fair view. Right? So again, we are on point number 2. What I have told you so far is every organization, they are required to prepare 2 separate books of account. One as per accounting rules, one as per taxation laws. Why do we need 2 separate rules? Because the rules are different. Why are the rules different? Because objective is different. Why is the objective different, or what is the objective? Accounting rules give us a true and fair view. Give us what's happening in your business, right? Give us a correct picture of where your business is. Taxation laws, not as much worried about giving us a correct picture. Taxation laws, how can we get higher tax revenue this year? How can we get faster revenue? How can we achieve some of the social objectives, right? Or other economic objectives? Okay, fair enough. Understood that. So what is the implication? So the implication is, and this is where it gets super interesting, the sales value that I record in accounting books and the sales value that I can record in taxation book can be different. Okay. So quite possible that you might end up having a different value of sales in the accounts book and taxation book because rules are because the rules are different, right? In the same way, all the cost that I record here and all the cost that I record in the taxation book, those could be different. So cost is different, sales is different. Is it fair to say that the profit before tax that I have in this book, taxable profit, right? So profit before tax that I have in this book and this book, that is also going to be different. So if this is XYZ, this could be ABC, which basically means the tax amount that I have here, okay, and the tax amount that I have here, those would be different amount. So here I can have tax as X, and maybe here I can have tax as A. Correct? So because sales is different, cost could be different, profits obviously will be different. So obviously the tax that I have to pay could be different. Now the question is, which tax am I supposed to pay? Am I supposed to pay the taxes as per taxation book or accounts book? Should I pay the tax as per the taxation book or accounts book? What do you think? The amount of tax that I need to pay. Come on, show me some energy here, guys. I want each one of you to participate. Please be active. Just 60 minutes of session, learn as much as we can, have fun with this topic. Tax that I actually pay, will I pay that as per the taxation book or will I pay that as per the accounts book? What do you think? The income tax, guys, when they call me, the IRS guys, when they call me, will they be worried about the taxation laws or will they be worried about accounting? Obviously, the tax that I'm supposed to pay is going to be here, right? So this is actually called as the tax payable. The tax that I'm supposed to pay is going to be as per the tax book. That's intuitive. No, it's not whichever is higher. I have to pay tax as per the taxation laws, right? It's that simple. That's why the taxation laws are made in the first place. But the expense that I show in my books is going to be this. So the expense that I show here will be called as the income tax expense. All right. And this is where then things get interesting. For example, if income tax expense is 500 and taxes payable are, let's say 400. Okay, so 500 and 400. Let's scenario. For some reason, it came out to be like this, where income tax expense is coming out to be 500, taxes payable is coming out to be 400. Then what do? Then you ask yourself, am I paying more? Am I paying more or less? Am I paying more or am I paying less? Here, you were supposed to pay 500, you're paying 400. This is what you're going to pay in cash, right? So this is what you're supposed to pay. So are you paying more or are you paying less? You're paying less, right? You're paying lesser value. So you're paying less. If you're paying less, then it becomes a deferred tax liability. As for the accounts book, you were supposed to pay 500, but the taxation book said no, you just have to pay 400. Okay, fair enough. Let me create a liability, so it becomes a deferred tax liability. And then second scenario, this income tax expense Independent scenario, income tax expense is 500 and taxes payable is, or taxes paid or payable, let's say 650. Now, what do? You ask yourself, am I paying more or paying less? Here, you're paying more. And if you're paying more, then what do you want to do? अगर हम लोग ज़्यादा पैसे दे रहे हैं, if you're paying more, then what do you think we should do? Then we, come on, then we create a deferred tax asset. And then obviously we circle back to point number 1 again, right? Which is where the whole concept started in the first place. So what point number 1 is telling us, if I'm paying less liability, paying more asset. Point number 2, building block number 2 explained why that happens, because different rules, therefore different books of account with different objectives, different sales, different cost, different profit, therefore different taxes. In some cases, you end up paying more. In some cases, you end up paying less. Okay. Now, this example is going to kind of help you consolidate what we've learned so far. So you might still have some queries, and it's okay to have them. But once I do building block number 3, more or less, you'll have a crystal clear clarity on what are we trying to do here. Okay, so let's start with the third subsection of this. And this is where we'll have to do some calculations. You guys will have to help me do the maths here. All right. So let us say that we have purchased a brand new asset, let's say machinery. Okay, you have purchased brand new machinery worth let's say 100. All right. Now we're going to charge depreciation at different rates in different books. So I told you the rules could be different. The rules could be different. So we'll charge depreciation at different rate. So let us say we charge depreciation in the books of accounts at let us say 30%, 40% in the first year, okay, of 100. Second year we will charge 30%, then we will charge 20%, and then we will charge 10%. 40, 30, 20, 10. What's the total? 70, 90, 100. So the rate at which we are allowed to charge depreciation is different in the books of account. Let us say in the taxation book, in the taxation laws, the rate of depreciation on this asset is different, okay, for whatever reason. So let us say the rate of depreciation is 20% per annum flat. Every year we will charge 20% per annum flat. Okay, no complication. And we will assume a revenue of 100 each year, 100 each for 5 years. We will assume a revenue of 100 each for 5 years. And let's assume a tax rate of 40%. So that's the basic information we have. What information we have? We bought a new machinery. It's worth 100. We're going to charge depreciation. That's my only expense here in this example. In the books of account, I'm going to get 40, 30, 20, 10 as the depreciation. So that's 70, 90, 100. Over the period of 4 years, I'll be able to depreciate everything. In the taxation laws, har saal 20 takka milega. Every year, I'll be able to charge 20%. We'll assume that revenue of 100 each year for 5 years. We'll assume tax rate of 40%. All right. Now look at how the accounting is going to work. We'll do it together. Wait for me. let's kind of do this one together. It's going to be super interesting. Throughout the reading, I'll try to maintain consistency. So I will write down, the accounts book on the left-hand side and the taxation book on the right-hand side. All right. Okay, here we go. So on the left-hand side, we will create the accounts book. Now, accounts book is more of, my language rather than the official language, but it will help you understand. Accounts book means books created as per accounting rules. On the right-hand side, we will write down the tax book. Tax book. Let's do it for year one. Here, we will say sales, we will say depreciation, we will say profit before taxes, and then we will say taxes. Same. Here, sales, depreciation, PBT, and taxes. All right. Everyone, please be with me on this. Let's kind of try to have fun. Year one. How much should I write in sales? We are in the books of accounts. How much do you think I should write here in sales? So every year we're going to have sales of 100. Right? Just an assumption to kind of simplify this thing. So every year we'll assume sales of 100. Currently I'm in the accounts book. How much depreciation do you think? How much depreciation do you think I should charge in the books of account? How much depreciation do you think I should charge in the first year? What amount of depreciation do you think I should charge? First year, this is an accounts book. Look at these rules carefully and tell me how much depreciation should I charge in the books of account. That's right. First year, we charge depreciation of 40. Assuming this is the only expense, it's a simplistic, setup. If this is the only expense, how much do you think will be the profit before taxes? How much do you think the profit before taxes here? Profit before taxes will become 60. Right? That's 100 minus 40. Profit before taxes 60. Now remember, your tax rate is 40%. So if I just simplistically do 60 into 40%, okay, 60 into 40%, what do you think should be my tax expense in the year one? Everyone, please, I want all of you to participate. No passive participants today. If I multiply this with 40%, I get 24. Okay. All right. So year one done. Now let's quickly do year two, year three, year four, and year five. We have to do it for 5 years in both the books. Sales each year is assumed to be 100. So no complication here. Sales each year is assumed to be 100. I'm going to need your help in figuring out the depreciation. How much should be depreciation for year two? As per the books of account, depreciation of year two will be 30. 30. Then depreciation for the next year will be 20. Depreciation for a year after that will be 10% of the original value. So 100 into 10% is 10. How about last year? What do you think should be the depreciation in the fifth year? Depreciation in the fifth year should be how much? Correct. You've already depreciated the whole asset. So now you're going to keep it as 0. Right? Depreciation in the final year becomes 0. All right. So let's do profit before tax. Everyone be with me on this. 100 minus 30, 70, 80, 90, and this becomes 100. Okay. Now I'm going to make a mistake somewhere. In case if I do, correct me there. So just be a little alert. Now tax, this becomes 28. This becomes 32. This becomes 36. And this becomes 40. What do you think? Are we together? Have you understood what we've done so far? All right, good. Let's go to taxation book. Year 1, year 2, year 3, year 4, year 5. Sales assumed value of 100 for each of the year. So sales, we assume 100 for each of the year. Depreciation. Depreciation of 20% per annum flat, 20% per annum flat for each of the year. So depreciation every year we charge how much? 20% of 100, we're going to charge 20, 20, 20, 20, and 20. Profit before tax 80, 80. Profit before tax is going to be 80, 80, and 80. At the rate of 40%, on taxation, so your tax value will become 32 flat, right, for each of the years. 32, 32, 32, 32, and 32. And we're done, right? We prepared the schedule. Now we have an overview of what's happening in the two different books. Now the real game starts. Next 5 minutes are super critical. You focus for next 5 minutes. You're going to sleep with a happy face tonight because you're going to get solid hold on how this reading works. Okay, so next 5 minutes, I need 100% of concentration. All right, everyone, look at this carefully. Accounts book means how much I was supposed to pay. Accounts book means how much I was supposed to pay. So I was supposed to pay 24 in the first year, but the amount that I actually paid was 32. So you want to think of this amount as paid. The correct word is payable. The correct word is payable, but just for simplicity, think of this amount as paid. All right. So now I was supposed to pay 24. I paid 32. Have I paid more or have I paid less? I was supposed to pay 24, but I paid 32. Have I paid more or less? What do you think? I've paid more. Correct? I've paid more. So when you pay more, what do you think you need to create? When you're paying more, what do you think you need to create? You need to create a deferred tax. You need to create a deferred tax. Deferred tax. You need to create a deferred tax asset, right? So we create a deferred tax asset. Now, question is in which book? Obviously, in the accounts book, right? We're kind of accountants when we're studying this reading here in CFA curriculum. So here, I will simply think of this as two isolated departments in an office, right? So accounts guys sit here. These are your accounts team, and the tax people sit here, okay, within your office. And again, I'm exaggerating, but at the end of the year, the accounts guy picks up his phone. He calls up one of the tax guys. He says, "How much are you paying this year?" 32. Okay, my book shows 24. No problem. Thank you very much. You're paying more. Let me create a deferred tax asset, which is the difference of the two. So 24, 32, and 24, difference of the two is 8. So in the first year, you create a deferred tax asset of 8. Sit. The accounts guy called the tax guy. He asked him or her, how much did you pay? Let's say she said 32. You said, okay, fine. My books show 24. I'm paying more. Let me create a deferred tax asset of 8. Let's see what happens next year. Next year, same story. You do your accounting. You figure out, we should probably be paying 28. You call up the tax guys. You ask them, hey, how much are you paying this year? Those guys say, we are paying 32 this year. So you say, okay, fine. You're paying 4 extra. If you're paying 4 extra, if you're paying 4 more, then what do you think will be deferred tax asset in the second year? What do you think will be the deferred tax asset in the second year? Second year deferred tax asset will become, this gets super interesting here. Second year deferred tax asset will become, come on, not even a single person is giving me the correct answer on the chat box. You were supposed to pay 28, you paid 32. Second year deferred tax asset. Jigar, fantastic. That's right. Steve, spot on. Amay, yes. Thank you very much for answering. Aryamar, that's right. 12, not 4. What? Where did this 12 come from? This 12 came as last year you paid 8 additional. This year you paid 4 additional. So till date, we have paid 12 additional amount, 12 extra amount, 12 excess amount to the tax department. So deferred tax asset becomes 12. It's a cumulative item. पिछले साल 8 ज्यादा दिया था, इस साल 4 ज्यादा दिया, so total 12. Last year I paid 8 more, this year I'm paying 4 more, that's why it's 12. All right. Next year. Okay, next year. I hope you're with me on this. Next year, you are supposed to pay 32. You call up the tax guys, they say, you know what? Surprise, surprise. This year our amounts are tallying. We are also paying 32. 32. So what do you think you should do with deferred tax asset now? Your deferred tax asset now will become, let's see if you can get this right. Yes, it will remain as 12, not 0. Why? First year you paid 8 additional. Second year you paid 4. Third year, tallied. Nothing additional paid. Deferred tax asset becomes 12. It's a cumulative item. It's an asset. Assets are cumulative, right? All right, next one. Ab maza aega. Next one. Everyone, I told you 5 critical minutes. So maybe last couple of minutes now. Next one. Now something strange happens. Okay, what happens now? You do your books of account, and this year your account says, your books of account says 36. Then again, you call up the tax division, within your office. You tell them, hey guys, I'm sure you've done your calculation. What's your number? Those guys say, my number is 32. You say, what? You're paying less? They say, yeah, we paid more. We paid higher amount in the past, right? So now we have to pay less because we've already paid more in the past. So now this time around, it's kind of getting reversed. You're supposed to pay 36, but you're going to pay 32. You're going to pay less because you paid more in the previous year. So you will say, okay, now my deferred tax asset will become 8. It is not a deferred tax liability. It is a reversal of deferred tax asset. That's the term we use here. Okay, the term that we use, we call this as reversal of deferred tax asset. So reversal of deferred tax asset is going to be 8. I mean, the value is going to be 8. How is that calculated? 8, I paid extra in the first year. 4, I paid extra in the second year. Third year, it tallied. Fourth year, I paid a lesser amount of 4. It's like just picking up your call and telling the the IRS or the income tax department, telling the government, you would say, hey guys, I know I'm supposed to pay 36, but if you remember, till last year, I've already paid you 12 in advance. So therefore, I'd like to use credit of 4 this year. Therefore, I'm going to pay only 32. So my balance remaining with you paid in advance is 8. Okay. And here's the magic now, the last year. Your calculation comes out to be 40. You call up the tax guys in your office. They say, you know what, pay 32. You say, okay, I was supposed to pay 40. I'm paying 32. That's because I've already have given an advance of 8 at this moment. So my deferred tax asset now. Correct. Amay, Amay is spot on. Amay is saying, जो जमा है उसी में से काट लो. My deferred tax asset now becomes 0. This is again a reversal, right? What reversal did happen? So we had 8 in the first year, 4 in the second year, 0 in the third year, minus 4 in the fourth year, and finally minus 8 in the fifth year. So this is how the deferred tax accounting kind of works. Hisab barabar, accounts tallied. What do you think? Easy? Or not so easy? I pass, I struggle. I have no clue, I'm confused, I'm lost. Good. Now, let me show you something really interesting here. Okay, you're going to be blown away with what you see now. Let's take total of each of these columns. Okay, let's start taking total of each of these columns over a period of 5 years. So let's take total of the sales here for 5 years. The total here is 500. Let's take total of depreciation over the period of 5 years. So 70, 90, 100, the total of depreciation, 100. Let's take the total of profit before tax over a period of 5 years. That's 130, 210, 300, 400. So total 400. Let us take the total of tax expense over the period of 5 years. So how much will that be? 32, 52, 54, 84, 84, 90, 120, 160. 160. Total here in the tax book, 500, 100, 400. And how much will this be? This will be 160 again. What do you see? See something interesting? What you see here is the total revenue that I'm recording, either in this book or in this book, is same over the period of 5 years. The total depreciation that I'm getting, either in this book or in this book, same over the period of 5 years. Total profit before taxes, same over the period of 5 years. In fact, the total tax that I'm showing as an expense and I'm paying in cash to the tax division is also same over the period of 5 years. Correct? So when I do this accounting on a totality basis, it looks like, it's going to be the same. It's look like it's same. Where is the difference coming in? If I'm paying the same taxes over a period of 5 years, 160, where do you think the difference is coming in? Why do you think the difference is coming in? If the taxes are same, right? Over the period of 5 years, my tax expense is 160. Over the period of 5 years, taxes paid is 150. तो फिर फर्क कहाँ पे आ रहा है? Where is the difference coming in? Difference is coming in because of, I'm expecting you to feed in a word for me. I'm expecting you to kind of give me a word, feed in a word for me that will be a logical transition to the point that I'm trying to prove. The difference is coming on account of difference in depreciation. But isn't the depreciation same over the period of 5 years? It's not that depreciation is different. Over the period of 5 years, depreciation is same. What is different with the depreciation? Come on, can anyone feed in that word for me? Correct. The difference is of timing difference. Correct. There's a timing difference here. See, on totality basis, it's the same thing, right? I charge depreciation of 100 in both the books. The difference is in the timing, where in the accounts book, I go front loaded. So I charge more depreciation at the beginning. In taxation book, I go linear, I charge less depreciation, right? So it's a timing difference. Or we can say it is also temporary difference. Correct? Over the period of time, it's going to be same. It's just a temporary difference. If I charge more depreciation here in the earlier years, then I will have to charge a lower depreciation in the later years. So it's a temporary difference or it's a timing difference. And we create a deferred tax asset or a deferred tax liability only and only for the timing or temporary differences. So whenever there is a timing difference or temporary difference between the two laws, this results into creation of deferred tax asset or deferred tax liabilities. All right. So with this, more or less, we've kind of learned what we've wanted to learn. Let me give you a super quick review so that you consolidate this nicely, and then we can start layering on top of it from tomorrow's session. So I'm giving you a quick 5-minute review. We're currently on income taxes. We started the session by looking at a fundamental concept where I said, if I have an expense and if I pay less amount, I create a liability. If I pay a higher amount, I create an asset. Same logic applies to taxes. If I pay more taxes, it's a asset. If I pay lower value of taxes, it's a liability. Second concept we did is we said, see, every organization is preparing 2 books of account. Okay, 1 books of account, 1 set of books is as per the accounting standards, 1 set of books as per taxation laws. And these books are different because rules are different. Rules are different because objective of these rules are different, right? Accounting is, wanting you to show like the fair thing. Taxation, they want you to show, they want to collect maybe higher money. So because the rules are different, we end up having different profitability. It results into creation of DTA or DTL. And then we did this example where we said, okay, can we, learn this concept with the help of some numbers? And by the way, this example 3 is critical because I'm going to layer up entire reading on top of the same example. Okay, there are another 3 or 4 concepts that I need to deal with. I'm going to do everything with the help of this single example. So it's critical that you understand this. So we did machinery of 100, and then we have depreciation rate in different books. We had different profitability, therefore different taxes. But over a period of time, it gets settled. You end up paying the same. Therefore, it's called the timing difference or temporary difference. Right. So with this, the session is over for the day. Thank you very much for showing up. I hope you found the session useful. It will take me 2 more sessions to complete this reading. The subsequent sessions obviously will be streamed on the FinTree app, same time tomorrow morning at 8:10 a.m. And these class notes I'll be uploading at your regular class notes page on the FinTree LMS, and I'll also upload them in the YouTube description, so you can download them. All right. So with this, thank you very much. You guys have a great day. I'll see you tomorrow morning, same time.